MIT professor of economics Kristin Forbes has studied rate cycles through history and took the opportunity in Aspen to put what we're seeing into a broader context.
There had been a leaning before the pandemic and the post-pandemic inflation to wait till you saw inflation, till you saw the whites of the eyes of inflation. And I think the lesson is learned. We need to allow central banks to be preemptive. They need to be able to start raising interest rates ahead of time when they think prices are going to pick up quickly. Related to that, I think an important lesson we've learned is that as economists, central bankers, we focus on inflation. So there's a lot of discussion now on how inflation is coming back. It's heading back to 2%. This has been a remarkably pain-free recovery, but it hasn't been pain-free. The price level has increased. It's more expensive for consumers to buy what they need to buy to keep their households afloat. And as economists, we forget that this price of a basket of goods matters to people. Things are more expensive. It's the price level that matters to people, not just the rate of change of prices. So I think we've learned an important lesson that the level of prices does matter. Even if inflation comes back down, the increase in inflation in the interim can be painful.
You're an economist, of course, not a politician, but I wonder what you just said. Well, that might help explain something that I find remarkable. The economy is quite strong in the United States right now, and yet a lot of people don't feel good about it. And we keep saying, well, inflation is coming down, we're getting under control, and it doesn't seem to be registering.
Yeah, and I think that's exactly why, is that as economists, we see inflation coming down, heading to 2%. They think everything's fine. If you look at actually where we are in this cycle, it's quite remarkable. We have had remarkable swings where unemployment increased, and now it's come back down. We saw GDP growth collapse, and now it's come back. So things look good in terms of the finish point. Inflation is coming down too. But yet in the interim, we saw the price level increase, and everything just costs more. So even though the end point looks good, there's been a lot of pain to get there.
You've said that we should not wait till we see the whites of the eyes of inflation. That means they should be a little faster on the trigger. Is a corollary of that they should be more flexible in coming back down as well? I mean, there's some sense that once we start moving in one direction, we have to keep going in that direction. We're even talking about that now with cuts. Once they start, they have to keep going. Do they have to be a little more flexible on the up and down sides?
So I think another lesson we've learned is that central banks need to be cautious about boxing themselves in ahead of time. There's always shocks. There's always surprises. You need to keep your options open to go in both directions. And you need to be able to pivot quickly. I think part of the reason why central banks were slow raising interest rates this time is they had locked themselves into so much forward guidance, locked themselves into asset purchases. It was slow to pivot when the situation changed. And similar now as we're looking forward, there could be some major changes in economic policy, which might mean the central bank will have to change policy quickly. So they should keep options open going forward.
In law, we say hard cases make bad law. Is there an equivalence in economics in this sense? We're probably, we hope, not going to have another pandemic that shuts down the economy right away. So I'm not sure we're going to have this kind of fiscal stimulus again. Is there a danger in fighting the last war and making a mistake on the next one?
Exactly. I think that is another lesson we've learned is the change in the Fed's mandate and how it responded was partly a response to the decades of very low inflation where people were less worried about inflation picking up. And now we've seen the opposite where inflation can pick up quite quickly. So as central banks go back and rethink mandates, that should be front and center as we need to rethink mandates for all different scenarios going forward.
You've done research and analysis about the sort of rate cycles going back quite a ways. Was this one different from all the others?
Yeah. Great question. What's fascinating is when you look at this most recent rate cycle, there's some ways this is unique and unprecedented. There's other ways it's just like rate cycles from the 1980s and 1990s. I recently wrote a long paper on this for Sintra with a couple of co-authors at the World Bank, and we described this rate cycle as similar to the parable of the blind man and the elephant. I don't know if you've heard this one, but according to the parable, several blind men are told they're going to be introduced to a mysterious new beast. And each of them can only touch one part of this mysterious new beast, which is an elephant. And depending on which part they touch, they come up with completely different conclusions. You know, if you touch the trunk of an elephant, you think it's a snake. If you touch the leg, you think it's like a tree. If you touch the ear, you think it's like a fan. And similarly, when you look at this rate cycle, in some ways it's like nothing that's come before. In some ways it's a lot like past cycles. But let me give you a concrete example of some ways this is unique that we haven't seen before. One is just the swings in economic activity, the collapse in activity, the collapse in employment, and then also the rebound. We've never seen such a quick rebound in the labor market, in activity, and in inflation. Another way this cycle has been unique is that central banks, on average, across the advanced economies, were slow to respond to the pickup in inflation and recovery, but then they responded by being unusually aggressive to make up for being slow. So it's the most synchronized period of rate hikes we have ever had, at least in the data I've looked at since 1970. And it was also followed by central banks keeping rates on hold for longer, on average, than they ever have at their peaks. So unusually slow start, but then aggressive response, hold rates at their peaks for longer. And what's remarkable, despite all those unprecedented characteristics of the cycle, we're now settling about where you settle 2.5 to 3 years after you start hiking rates.
Well, I'm curious about that very point. There's a lot of debate about when the Fed is going to cut and how much they're going to cut and things like that. Maybe more important is where they end up. Where it ends up, whenever that period of time is. And given your study of rate cycles, do you have a sense, because some people think we're going to end up at a higher level than we were before, where you call it R star, neutral rate or whatever. Other people say, no, we're going to go back down to lower rates. Do you have a view on that?
So based on my study of historic rate cycles, what it suggests is rates may not go down as low as most people are expecting, or as, say, the Fed's dot plot is predicting. Based on this historical comparison, looks like things are largely normalizing now where you would at this point in a rate cycle, which means rates are probably settling not far off where they're going to settle. And rates now are about 5.25. Which means they would not be going all the way down to the sort of 3, 2.25, 3.5 that is in the Fed's dot plot right now, given where all the other measures of economic activity are.
One of the things that central banks have to deal with is uncertainty from the fiscal side and the government side. And they can't, the Fed does not want to be political, really avoids that at all costs. At the same time, politics does affect the economy. As you look forward to this election, should the Fed be going to some scenario planning alternative, as I guess former Chair Bernanke recommended for the Bank of England?
Yeah. I think that should be a no-brainer. We don't know how the world's going to come out, but there's some scenarios that there's a good chance could happen. So central banks should be thinking through, if this happens, here's how I should respond, and they should let people know how they would respond, because it's the unknown unknowns that are the biggest risk. So if central banks can get ahead of some of these policies and say, if these things happen, here's how I'll likely respond, you hope then that consumers will be ready and businesses will be ready, and then if there is a sudden change in rates that's not the sort of consensus path, people will at least have hedged against those risks or be ready for them.
Sort of a forward guidance with a bell curve, as it were, right?
Or multiple forward guidances of if A, then B, if B, then C, and then people should take that into consideration and not lock themselves into an assumption of where rates will be.
There's a great deal of concern, at least in some quarters, with the federal debt and deficit right now and what that might mean. I wonder what it might mean for the Federal Reserve. Does there come a point where, in fact, it has less influence, certainly over long-term rates, over rates in general, because the bond market takes it away from them?
That is certainly a risk. That's a risk they hope will not happen, but we saw it happen in the UK when Liz Truss announced her mini budget, and then people worried about sustainability. Suddenly interest rates spiked, and you couldn't adjust that through normal changes in interest rates. The Bank of England had to go in and actually do asset purchases to help stabilize the market. That is not a position any central bank wants to be in. So hopefully the government will address its fiscal problems before we get to that point.